Good afternoon, everyone. I'm William Asai Renchi, a training coordinator at the Temple Small Business Development Center. The Temple SBDC helps small businesses start and grow through our no-cost consulting, webinars, and training programs. We are proud to be part of the national accredited network of SBDCs with over 1,000 centers across the United States. You have joined us today on this webinar on the topic, Founding Foundations, How to Build a Business That Lenders Will Trust. A follow-up email will be sent to all attendees within the next 2 business days with today's materials. All attendees have been muted. However, we encourage you to post your questions you may have in the Q&A section. Now, I'll turn over the floor to Ray, Tom, and Brian. Thank you.
Alrighty. Let me just give a little bit of an introduction for myself, as it were. Thank you, William. My name is Ray Hayden. I am going to be a 3-month employee at the Temple University Small Business Development Center. But I've been with the network for going on 9 years. So even though I'm new to the center, I've been doing SBDC business consultant work for a while. And prior to that, I was in commercial lending, specifically government finance, working with SBA DCD, so Department of Community and Economic Development through the Commonwealth of Pennsylvania programs, as well as local government programs. So during my time at the SBDC, I've worked for 3 centers. Wilkes University, Bucknell, and now Temple. I've been kind of the capital acquisition go-to person for clients who are looking to secure funding. We have, besides me, obviously 2 panelists, Thomas Dowling from Pursuit and Bryant from Entrepreneur Works. It is great to have you guys. If you want, we can give, would you mind just giving a little bit, maybe like a 20-second introduction about you guys before we go into a little bit of what Thomas's presentation from Pursuit?
Brian, why don't you go first?
Yeah. So, good morning, everyone. My name is Brian Kill. Again, I work at Entrepreneur Works, which is a CDFI based in Philadelphia. I work directly with entrepreneurs who are either trying to get funding or trying to understand why they've been denied or are not at the point where they require the funding yet. I'm also a small business owner. I run a landscaping and removal company called UDS Philly, Urbanic Development Services, and I'm a real estate owner or manager as well. I currently own 10 units here in Philadelphia with the hopes of buying another 90 within the next 10 years. Great to be with you guys.
Thank you, Brian.
Tom Dowling, I'm with Pursuit. We are also a CDFI. Pursuit has been in business for almost 70 years now, and we operate in New York, Pennsylvania, New Jersey, and now Delaware. And we try to provide access to capital to small businesses, from startups to established businesses, through the use of our own funds, state funds, and also SBA loan programs.
Excellent.
Prior to that, I was in SBA lending for the better part of 30 years. So I've been very familiar with the challenges of operating through upticks in cycles, downturns in cycles, and helping businesses transition from period to period. And in between all that, there have been a lot of events that have continued to sharpen our skills in terms of understanding the needs of small business owners.
It's an adventure, isn't it, Tom?
Oh, absolutely. It never gets dull.
Very good. Very good. Yes, I remember the same thing during it wasn't quite 30 years, it was more like 10, but variation on a theme, certainly my share of adventures in commercial lending and specifically with government programs. Fellas, if you don't mind, just because I'm not sure if everybody understands what a CDFI is, would you mind just elaborating just a little bit?
Yeah, so a CDFI is a community development financial institution. We operate similar to a credit union or bank. However, we're mission based, so most are nonprofits, and we have a target market that we lend to for the most part. And we're backed by the CDFI fund, which is with the government. So a lot of our how we regulate our loans is a lot different than banks and credit unions. So it's I won't say it's easier, is less stringent and less red tape when it comes to getting loans from a CDFI.
Yeah,
Thank you
and
for the
to
explanation.
piggyback on what Brian said is that, although we offer funding much like banks, our primary mission is to meet the credit needs of the small business community in the low to moderate income areas, but not exclusively to those areas. So, you know, it's ideally it's trying to capture as many things that might fall between the cracks, and knowing that there are, and helping people understand that there are other resources available. And prior to actually working with Pursuit, I didn't really fully understand the scale and scope of what a CDFI does. I understood that they lent money, but there are so many things we do in addition to that in terms of business advisory services that we can provide on the post loan basis. Now, there are some CDFIs that also do that on a pre loan basis. So, really understanding all the tools and benefits that we can offer and bring to the table to help the small business community. And unfortunately, we don't have the billboard strength or the financing to showcase all of that. So we have to rely on some of our business partners and resource partners to help us spread the word.
Gotcha. Tom, that actually serves as a swell segue, in my opinion, for your presentation. So if we'd like, why don't we foray into that? Fun fact, really quickly, I didn't share this with y'all, but I used to be a bank regulator too. I hope we can still be friends, Tom and Bryant, but I was with the Department of Treasury, the Office of the Comptroller of the Currency, for about a year also before reverting back to economic development. So it's a good change for sure. Shall we, Tom?
Sure.
Alrighty.
Okay. So as we stated, it's just an overview. Pursuit, what we try to do in terms of partnering with business owners to provide meaningful solutions. So if you want to go to the next slide there. As a little bit of an overview, we've been around since 1955, so almost as old as the SBA. And we actually started as a consortium of 10 banks that came together that said, we need to provide a platform for small businesses to get financing that we can't do for whatever reason. It didn't meet their credit box, but it made sense to get that to them. So we have a number of different programs and upwards of 15 different loan programs. And we didn't start out with 15, but as we've grown, we've gotten pretty good at identifying different sources and different needs. And so as a result, we have programs that are for existing businesses. We also have programs that are for brand new businesses. So what we try to do is identify, is it something that a project that we would want to be able to work on, bring it in, and then try to identify what is the best package of programs to place them into. So if you want to go to the next screen there. So a little bit about a CDFI loan. Again, because we are not as regulated as banks are, we can be a little bit more flexible in terms of credit, collateral, cash flow, time in business. And ideally, what we try to be is a smarter alternative to the more expensive financing that might be out there. Might be in the form of credit cards or some of the online lenders. Not to say that those are bad types of financing, but it might not always be the best type of financing for a given situation. So we try to provide access to capital as quickly as possible. So we have an online application system, which allows us to do everything very quickly and very securely. Loans up to 100,000, we can typically decision within several business days, and funding can be in as little as 7 business days. The fastest I've gotten done is 9 business days, but nonetheless, comparatively, that is pretty quick. And interest rates typically will vary depending upon the programs in which state we're in. The lowest we have is 4.5, and that's for a program in Connecticut. And most of our programs in Pennsylvania are going to be sub 10%. And if you want to go to the next. So typically, our loans will go up to 500,000 with terms up to 10 years with a fixed rate. Loans under 100,000 are typically only UCCs and a personal guarantee. So it's not a lot of reliance on additional collateral, which can often be a stumbling block for some loan applications. And we get funding through a variety of sources. Again, when we first started out, we had very limited resources, but over time we've gotten involved with state governments, foundations, grant programs, as well as some of our bank partners to help provide access to these funds. And where we get the benefit of being able to save money there, we try to pass on to the borrower. And as far as eligibility, at least in this case, Pennsylvania, business must operate in Pennsylvania. And our threshold is break even or positive cash flow. So whereas if you go to a bank, they might say we have a minimum debt service requirement of 1.25 times your cash flow debt service. We can go 1-to-1. And a credit score of 640 or above, again, some banks will screen out. If it's under 700, we don't even continue the conversation. So we have a little bit more flexibility there. And we just ask that there are no tax liens or bankruptcies. So those are the high level eligibility. So if we can get clearance on those items, there's a pretty good chance that we'll be able to structure some financing for it, the business.
Tom, just a clarification question. For recent bankruptcies, if you don't mind me asking, how is that defined? Is it like none within the last 2 years?
Depending upon the programs, and it's also the specifics of it. Sure. Because there's Chapter 7, there's Chapter 11, there's Chapter 13. Understanding the circumstances that may have prompted it, as well as the time frame that it may have occurred. Some programs say 7 years. Mm-hmm. Some may say ever.
Okay.
So it's a matter of understanding, what the circumstances are and are there mitigants. So some of those items are etched in stone, mm-hmm. but there might be some flexibility there that, given an appropriate explanation and documentation, that we might have the basis for making an exception.
Sure. Thank you for that.
And as far as documentation, although it says here 2 years of business tax returns, if we can show 1 year of business tax returns that shows cash flow, we can fund it. But typically no more than 2 years, current photo ID, a debt schedule, interim financials, and if we are relying on projections, a business plan, and projections along with all the assumptions so that we understand exactly how they got those numbers.
Just as a reminder, folks, that is something that the Temple SBDC and SBDCs in general can help with. Business plans, financial projections, and written assumptions, for sure. That's something that you can work with a consultant. And just as a friendly reminder, our services are generally at no cost to our clients.
And that's a very good point that you brought up, Ray, is the fact that we're all affiliated with those services.
Mm-hmm.
The SBDC can do some of those pre-loan type things, but there might be some things that once the loan is granted, they may continue or may not continue.
Yes.
And then it could be a handoff where we get involved and facilitate. We rely on our service partners like the SBDC because if we're relying on a business plan, we want to have somebody who has experience in looking at business plans and critiquing the business plans and understanding all the vital components of a business plan and understanding the marketplace, as well as sensitizing and really critiquing the projections as well and making sure that are they capturing all the required expenses and operating structures, whether it's the taxes, rent expenses, utilities, etc. Because unfortunately, I've been on the receiving end of some very good-looking business plans, but when you drill down and look at them and analyze them, it was all form over substance because the numbers did not make sense. So it's really understanding to make sure that given the type of business and where it's located, who's the competition, what are the barriers to entry, and just as importantly, are the expectations and the numbers regarding payroll and staffing costs, are they realistic for that marketplace? Because
Thank you, Tom,
that could be wildly different. Whether it's in the case of Center City, Philadelphia, or say Lancaster, PA, different operating costs entirely.
For sure. Yeah, thank you for that insight, and thanks for putting up, y'all, with my shameless plug for the SBDC.
Yeah. Now, I had mentioned the business advisory services. So we do all our business advisory services are on a post-loan basis. So all of our loan borrowers are eligible for the business advisory services, and that is completely free of charge. And that can be business consulting to cover financial management, forecasting, marketing, how to grow my business, how to manage my expenses, HR, how do I grow, operations, as well as personal credit and readiness. And we are also expanding into legal advisory services as well, because there are so many things that come into play with, and also security, cybersecurity. That is another area that a lot of small businesses really don't know as much about as they should, and we're trying to help them in that respect.
Okay. Thank you so much. Obviously, we have Tom's contact information here, but I believe we'll be sharing that, or we can share that with the attendees, if you don't mind, Tom. I imagine you don't mind, considering it's there.
No, not a problem.
Very good. Thank you so much for that presentation. Bryant, you're up next to share a little bit about what you all do at Entrepreneur Works.
Yeah, so I talked a little bit about Entrepreneur Works a little earlier. So basically, we're a CDFI and we service primarily startup businesses and new businesses, and in some ways, some established businesses. However, where our sweet spot is really in the startup and new businesses. And I won't get into too much about the details of that unless there's questions. What I wanted to do is talk a little bit about kind of some expectations for expectations new businesses and startups have. And I wanted to debunk that and then talk about some core truths as it relates to lending. So right away, a lot of new businesses and startup businesses, when I meet with them, they have this belief that if they have a great idea, that they will get funded. And that's not really how it works. The idea alone won't get you funding. So what it really boils down to for us and for me is the execution, behaviors you've established and developed, which I'll talk about in a little bit as it relates to the core truths, and then the trust. So the first core truth, so there's four. The first one is funding is about trust. So every lender is asking one question. When you sit across from me or we're on Zoom or we're out getting coffee, the question I have is if I give this person or lend this person the 10 or the business 20, 50, $100,000, how confident am I that I will receive the funds back, right? And that confidence comes from patterns that you've developed prior to you sitting down with me or any other lender. And I will list some of those in a little bit. The second core truth is you need healthy financial records. If your numbers only live in your head or someone else's head and it's not down on paper, if it's not down in Excel, if it's not down on Quicken or QuickBooks, somewhere where it's organized, clean, then it doesn't really exist. And a lot of lenders, a lot of businesses kind of inflate their numbers sometimes because they don't really know what's coming in and what's going out, and there's some discrepancies. So record keeping is of the utmost importance when it comes to your finance. Even if you're a startup business, you need to know what's coming in and coming out personally, and then what is your cash flow projections going to look like in the future. So some of those assumptions that we were talking about. And then the third core truth is your personal credit still matters, right? So a lot of people believe that now they have a LLC and their personal credit and personal finances don't matter as it relates to getting a loan because the LLC is going to blow up and they're going to be making $1 million next year. That is not the case when it comes to startup businesses and new businesses, and in some cases, established businesses as well. Early on, what we look for is that your personal, you're personally guaranteeing the loan. So your personal income and credit will sustain you, God forbid, if the business weren't able to pay the loan back. So that history is very important. And personally guaranteeing is normal at that stage. It's not a punishment. It's just risk management on our end if you are not to pay the loan back. And then the core truth number 4 is timing is important. What I've been realizing, so I've only been with Entrepreneur Works for the last 3 months, and before that, like I mentioned, I was running my own business, so I know what it's like from that perspective as well, applying for a loan and what lenders look for. Now, obviously, being a loan officer, I have a more understanding about it, but timing is important. So most entrepreneurs, they come in either too late for a loan or too early. And too early looks like you don't have a EIN, right? You're not registered with the government and state. You don't have cash flow projections. You don't, understand credit. You don't have a business plan or marketing strategy. And too late for a lot of lenders, and I get this a lot as well, is you're 3 months behind on your lease agreement, or you owe high credit card debt and on the business side, and for that reason you need a loan to get out of the situation you're in. So what we tell people is you want to be right in the sweet spot is if you got this loan, so you've prepared for this. If you got this loan, this will take you to that next level, and we can talk more offline about what that means specifically, or if you have questions we can talk about that. So my last point is I wanted to discuss is what is a slam dunk and what is a tough sell. For us at Entrepreneur Works is, working with startup companies and small businesses, a slam dunk can be a strong business plan, right? An established and registered business. you have clean bank statements, right? And your clean meaning your personal and your business bank statements aren't intermingled, right? You're not robbing Peter to pay Paul, or like, using your personal account for business transactions and vice versa. You have basic bookkeeping set up, right? That's a slam dunk for us. Like, do you have QuickBooks, Quicken, Excel? Can I track the numbers? Does the numbers tell a story? And then you have constant sales if you're already established, right? There's no, points in the business where for 6 months you didn't have any sales. That tells me that, there's some, issues you need to work out in marketing and sales and strategy and things of that nature. And then some tough sales for us is the plan is in your head, or the marketing strategy, your SWOT analysis, how you're going to get to that next level is all up here, and you haven't strategized it on paper. You have mixed business and personal accounts, and your numbers are unorganized, and your plans are vague. They're not truly detailed enough to get you to that next level. So, in closing, I'll say funding isn't something you qualify for one day out of nowhere, right? It's something you build towards, something that you've created structure around and clarity and relationships to help you get to that next level. So that's my spill on kind of those core truths and what it takes to get funding in the CDFI world. There's more detailed things we can discuss in terms of like the 5 C's of credit, like collateral, credit, character, like all these things and so on and so forth. We can do that either if you have questions pertaining to that or on a one-on-one meeting.
Hmm. Thank you, Brian. I really appreciate your overview and your insight. One thing, just to piggyback off of what you said, plan in your head versus plan on paper. And the one thing I will say about the SBDC, and I think just in my experience, it's been really important to small business lenders, is that you write your actual plan. All right. I think nobody should know your business better than you. Nobody should have the strategies. You can be informed about strategies and certainly be influenced by the way others have done things in the past, proven records for success. But ultimately, it's your ideas and your plan that you should be writing. Okay? And that's one thing I will say about the Temple SBDC. We don't write the plan for you. We ask that you put together a draft, and we will work with you to make it the best document that it can be. Really quickly, and I know we have some questions, including Brian, your contact information, but Brian, if you wouldn't mind just kind of going over like a broad definition of personal guarantee. I think that might be a little foreign for some of the folks in attendance.
Yeah, so when you apply for lending with us, let's say you walked in, you were ready to, get a loan, and I said, yeah, go ahead and apply. You would apply, and we would run your personal credit, and that, based off of that, we would get the score and see if one, you can cover the loan on your own, like they call it global debt servicing, or personal debt servicing, and then from that, God forbid, if you defaulted on the loan, that will show up on your personal credit, and then you would be required to make that payment personally outside of the business. So that's what a personal guarantee is like you're personally liable for this business loan, and to pay it back, not just your
Mhm.
LLC or your S corp.
And I think that's really important distinction, folks, because to Brian's point earlier, folks will try to mitigate liability by setting up business as something that's separate from you, right? But lenders see through it and will find a way, by way of the personal guarantee, to make sure that you're personally on the hook, and you should expect that to be a major, like, um, checkbox when applying for credit, especially folks, generally speaking, if you are an owner of your business, 20% or more, be prepared to offer that personal guarantee. Um, One thing also from Tom's presentation, tax liens and judgments, and tying into what Bryant said, don't lie about that, because frankly, the judgments will show up on your credit report. Okay. Um, And they will, if you have paid a debt, no, not paid, the opposite of paid, if you have defaulted on a debt, pretty hardcore beyond the 90-day mark, anticipate that your creditor will put a judgment against you. All right. Um, and generally speaking, to Tom's point, those puppies will need to be removed before anybody will really entertain um, extending you credit. All right. Even if you have, let's just say you have a property collateral, one of the 5 C's that Bryant had mentioned. Um, you have a property to put up for collateral. When they do something called a title search on that property and they see judgments, that's going to be a bit of a red flag. Not a bit of a red flag, probably a major red flag when establishing credit to you guys. So just be aware of that. I'm trying to I took notes and I just wanted to see if there was anything that might be a little foreign uh, to folks with regard to some of the, what did we used to call it? Like speaking banker, I guess, amongst those in the industry. Um, Debt service coverage, okay? That is your income divided by your debt, okay? And from that, obviously, that division will realize a debt service coverage ratio. If you have any questions on that or want to be further educated on that, as a capital acquisition person at Temple, we can help you with that for sure. All right. Let's see. Well, I guess at this point, if you all don't mind, let's see what the questions amounted to from the discussion so far. Hey, William, if you wouldn't mind just checking in on that.
Yeah, so I think from Andrea, she's asking you, so you only provide lending to nonprofits and not private. That's her question. And is Pursue the name of the program or the business, and the CDFI is the service? And could you provide a checklist of the prerequisites and required documentation for the Pursuit CDFI loan program? I want to ensure my startup financials and legal documents are fully prepared before I begin the application. That's the first question. Yeah.
Okay, so I'll jump in on that. So all of the loan programs that we have are designed for for-profit businesses. We do not do any nonprofit lending. So that's the first question. And as far as the checklist and some of the documentation, most definitely I can provide the checklist of some of those documents. One of the things that I'm also going to ask William to share is a slide that I have, which is just a capital continuum. And it helps people identify where their starting point is. It's all about your plan. If you're going to start looking for money, streamline the search and know where to start your search. If you're a brand new company, there are some guidelines to help you identify, where are the best places to look for that, so that you're not starting in the wrong place. And then once you find out where to do that, then you start asking what types of documentation will each place or each lending resource look for. Again, banks may have a certain set of criteria. CDFIs may have a different set of criteria. So understanding what's needed, because not everybody is going to ask for the same amount of information. Some will say, we don't do startups. Others will say, yes, we do startups. So really understanding the size and scope of your project, where it's located, doing some of that homework on the front end in terms of really defining it will help reduce some of the frustration in trying to get the financing. Because some of these programs are very specific in terms of where you can lend to. For example, Brian, with Entrepreneur Works, I'm sure you have a limited footprint.
Yes, we do. Mm-hmm.
And Pursuit, I can go to any county in the state of Pennsylvania. So that's a good thing. But not all CDFIs can go to every county.
No. So we only service Philadelphia and the surrounding counties outside of New Jersey.
Yeah.
We don't service New Jersey.
Yeah. So it's a matter of understanding what those things are, and as well as, what dollar amounts are involved, because not everybody deals with the same dollar amount. So it's really helping the borrower to understand that little mental checklist of, okay, what do I need? And what information will my lending partner need that will help make it a smoother process. I think that's very important.
Okay, thank you. Franca is also asking, do you also lend to affiliate marketers? What lending options do you have for startups that don't have years of business returns?
Yeah, I didn't understand the question. Can you repeat that? I'm sorry.
Okay, so the first question is, do you also lend to affiliate marketers? And second one, what lending options do you have for startups that don't have years of business returns?
Okay, so I'll take this one. So for the first question, yes, we do. And then for the second one, if it's a startup business, well, just so that you guys understand, for Entrepreneur Works, our minimum lending amount is 5,000, and then the maximum is 50,000. So we're really limited in how much we'll lend. We'll go below 5,000, but we typically like to start there. And then what's required for startup specifically is we'll look at your personal income. So a lot of, because you're you're personally guaranteeing the loan, a lot of what we would provide to you is based off of how much personally you can handle. We'll also want to see your business plan and cash flow projections. We'll look at 12-month cash flow projections, and then we'll look at any debts, business debts you've incurred while going through the process of getting the business started. And then we'll want to see your 2 years tax returns as well. So that's what we'll evaluate. And again, we'll only go max 15,000 for startup businesses.
So, with us, we have a program. We can utilize the SBA 7A loan program where we can go up to 350,000 in Pennsylvania as a startup. And that would be compliant with the SBA underwriting guidelines. We also have a program that we call our Flex Loan, which is up to $100,000. And it's a little bit more flexible in terms of our own guidelines. And the first year is less than interest only payments with a 5-year term after that. And all of our loans have no prepayment penalties. So we can go up to 100,000 on a startup. But when we do that, we want to be able to make sure that the business plan is rock solid. And that's where we rely on our partners, SBDC, SCORE, SBA, to make sure that does the business plan make sense? Does it cover all the bases? And just as importantly, we want to be able to make sure that the borrower owns that business plan, knows it inside and out. Mm-hmm. Unfortunately, there are way too many business plans that I've seen where you can tell that somebody else wrote it for them. Mm-hmm. And when they're asked about it, well, it's in the business plan. No, I need you're the one that has to implement it. You're the one that has to run this business. If you don't know it, that's a red flag for me. Mm-hmm. And again, with the projections, to be able to make sure that do those projections make sense given the location and the scale and scope of competition in the marketplace? And does the borrower have the capacity to implement it? And did they take all the work on the front end in terms of making sure that, putting it together, readiness? Did you do your homework? Did you do all your due diligence on the front end in terms of making sure that, okay, I cleaned up my personal credit, I don't have any missing paperwork, everything is lined up? And that's also a reflection on how well have you planned for this opportunity.
Absolutely. One of the things, friends, that is really important, obviously, that the numbers make sense, right? But one of the things that we facilitate, and I had mentioned this before, and it's something SBA, at least in my experience, has always wanted, is our written assumptions, a description of the assumptions as to how you came up with those figures, okay? Normally, we try to do for a first year, a month-to-month breakdown, right? And why is that important? Well, it demonstrates if you're new to startup, if you're a startup, maybe there's a ramp-up period, right, of your business, because it's not realistic to think that you'll be macking it out 5 minutes after you open your doors, right? Another thing that can be captured with a month-to-month breakdown. So let's just say it's year one is a calendar year, January through December, is the seasonality. Depending on your operation, maybe you're not so busy during the winter months, and then you pick up in the spring or the summer, and then you kind of, let's just say you're like an outdoor recreation facility. You pick up in the spring, the summer, and then you kind of die down or you lower activity in the late fall months, right? And then slower even still over the winter. But these are things that you should account for, and we can help you do when creating your financial projections. Another thing that banks do, all right, so you might create these financial projections, but banks tend to benchmark and leverage off of databases, okay, to use for comparison purposes to your financial projections, okay? So if you're saying that you're going to, let's just say you're saying that your net income is 50 represents 50% of your revenue, right? But everybody else on average is doing 15%. That's going to look a little peculiar, all right? So that's kind of also just to piggyback on what Tom is saying, that kind of lends into the whole realistic expectations, realistic projections with those figures. So just thought I'd make mention of that. We can go on to the next question, William, if you like.
Okay. So Leslie is asking if you are looking to establish a physical build out for a business, when do you start the financial assistance on a loan seeking process? Do I need an address, a rent or mortgage amount, a quote for the desired build out or equipment? How detailed do you drive this down, and how do we decide what is affordable?
So I can take that. We don't do real estate lending at Entrepreneur Works, but from an investor standpoint, I would say that you should start with a pro forma. This is something you would start, as soon as possible. You would put together just numbers. I highly encourage you to kind of Google if you don't know what a pro forma is. You would put together the numbers based off of, it's just kind of like a cash flow projections based off of what you plan on purchasing and all the expenses like taxes and any repairs and so on and so forth that will go onto that real estate. And then that pro forma you would then provide to a lender, and then they would evaluate that. So to answer your question, yeah, you would want to get all the things that you've mentioned down on paper via a pro forma.
And to piggyback on what Brian said is also being able to have backup documentation. So if there's a construction quote, the assumptions on build out, get some quotes so that we can at least say, there's validation of, this is the amount for that type of build out. Particularly for a startup, if a business is considering doing something, please do not go out and sign a lease first. We can work with the letter of intent, but it gives us the I guess the foundation for understanding, okay, you're looking at renting a 3,000 square foot building. Rent is going to be this much. You can do some expectations in terms of utilities, et cetera, and the taxes that go along with that. And does this type of business really need that size of a footprint? Mm-hmm. It gives us a little bit more room to understanding. It's like putting together pieces of a puzzle. You don't have to have all the pieces. You're building the framework. And at what point does a lender say, okay, I can get on board with this? Overall, I like the idea. Let's start filling in some of the more critical pieces. So instead of just having a letter of intent, is this something that will be converted into a lease? And then if there's build out involved, okay, get more than just quotes, maybe get some more defined written estimates for that work and the turnaround time for some of those things, material costs, purchases, et cetera. There's a lot of detail that really needs to be, I guess, finalized at that point. But major talking points, rather than just estimated numbers, we would want to be able to see some more definitive structures and parameters for a project.
Quick comment, if you remember from Brian's content, there's an element of trust, huge element of trust when you go into lending and when you enter into a lending relationship. But there's a saying, at least from my experience, trust but verify. And that's kind of where those documents come into play, right? You're saying that it's going to cost this much, but what is the verification to substantiate what your claim is? All right, William, let's go to another question.
Okay, so Andrea is also asking, is there score requirement for entrepreneurial works 650 as well? And second question, hi, what's the deal on buying an existing business? Do you require payments? Do you require down payments? And finally, is your type of funding is your type of funding profits and loss sharing financial model? Thank you.
Yeah, so to answer that first question, for Entrepreneur Works, there's no minimum requirement as it relates to the credit score. Yeah, I've done loans 580, 620. What it really boils down to for us is what is your relationship between you and your creditors, and what does the cash flow look like? What is your debt servicing capability currently? So, if you're delinquent on loans currently, and you're just avoiding paying them back, then obviously we wouldn't do a loan on something like that. But if you have established a relationship with the creditor and you're working and you're paying it back and you're currently on the upward trajectory as it relates to your credit, then we would certainly do a loan for someone with a bad credit score, what's deemed as a bad credit score.
And as far as the acquisition, typically we look for at least 10% of the project in equity injection. Depending upon the circumstances, may require more than that, but typically minimum 10% equity injection is required.
Okay. The next question, are there limits to what pursuit or EntreWorks loans can be used for? For example, do you lend for commercial real estate or only for operations equipment purchases?
Yeah, so we wouldn't lend for any real estate purchases or, equity loan. If it's going to be tied to real estate in any capacity, we wouldn't lend on that. So all of our loans are going to be geared towards the working capital, equipment, hiring, things of that nature.
As far as Pursuit is concerned, we are able to do real estate loans, but they must be for the benefit of the business entity, the operating company. So we utilize the SBA 7A program. We also are an SBA 504 lender, which is a real estate program. So, but it has to be for the benefit of the operating business. No investment in that respect.
So
Okay.
just to clarify, like with the investments, say you are in a situation where, oh, I found this awesome like place and like there are 5 apartments to it, and I can't wait to like collect rental income from this particular location. That might not be, correct me if I'm wrong, Tom, but that might not be the best scenario for pursuits programs.
Correct.
Yeah.
That is if rental income is the primary income for that property
Hmm.
for the repayment, we would not be able to do it. It has to be for the benefit of the operating business. So if someone were to have a storefront business that they operate on the first floor, and you know they want to buy the building because it has the storage space, the store, and there's an apartment upstairs. What drives it is 51% of the space must be used for the benefit of the operating business. So if you think of a mixed use property, a pizza shop on the first floor and they want to buy the building. If they meet the criteria 51% owner occupied space, that could be done with a 504 loan or 7A loan. If it's less than 51%, then it is investment in nature, and then we would not be able to do that. So apartment buildings, no, that's not something we would be able to do.
Thank you for the clarification. William,
Uh,
so we have about 3 minutes. We might have time for a couple more questions. So
yeah, I think
fire away.
we have just 3 questions left. So
Okay.
yeah. Okay. So do you all provide financing assistance for real estate investor who is seeking to increase its portfolio? Personal credit is above 700 and being in business for 2 years now.
We kind of answered that, I feel.
Yeah. So I think that is fine.
Unfortunately, we can't help that.
Okay. Then the last one. Is it a good idea to ask for a minimum amount just to establish some business credit? I think that one too. Then can you lend to someone that operates a group home business? Yeah, that's the last question.
I think it's always a good idea to line up financing before you really need to access the financing. Because when you need to access that money is probably when your finances are probably strained. So the time to line something up is in advance so that it's ready for when you need it. And as far as a group home, is it a for-profit business? That would be a big question, whether it's and how it's being funded, because there are a couple different types of scenarios where some could be eligible and then some could not be. So something like that, I always encourage, pick up the phone, give us a call, have a brief conversation, and we can try to identify whether or not it's something that does meet the eligibility or not. But you know, I have no problem answering phone calls for that type of thing.
I see a question here from Steph. Do you offer seller notes, 24-month standby payment? Steph, the seller note is generally from the seller, and the way that works is, let's just say a business is being sold for, well, let's just say that the seller is willing to finance, say, the entire purchase, right, of the business. Save maybe 10%. And let's, for easy math, it's $100,000. Okay. So you'd contribute $10,000 towards the business, and the seller would essentially effect a seller note, probably leveraging the services of a corporate lawyer or a business lawyer, right? And you would do the various documents. So in lieu of the client getting cash, up front, the whole $100,000, um, the $90,000 would essentially come piecemeal, depending on what the payment structure is. It's likely going to be monthly payments of principal and interest, set between you, the buyer, and then the seller, if that makes any sense. Okay. Now let me tell you this, and Tom actually, and Bryant, um, oftentimes you'll probably see clients if you have an equity situation, right? Requirement for your loan programs, or it's something necessary, they might, um, clients might want to entertain maybe a seller note, to substantiate that equity injection. In situations like that, maybe you could talk a little bit about it.
Sure. With regard to seller notes, uh, the seller note cannot be the only source of the equity injection. So, say for example, it's a 10%, 10% requirement. We cannot let the seller take the full 10%. The borrower has to be able to provide at least half of that, because again, for lack of a better term, they're pound of flesh. What are they bringing to the transaction? And that is for the SBA, that is a requirement. And we typically, even in our non-SBA programs, tend to mirror the SBA requirements. So if there's not any actual equity being brought in by the borrower, and even if the seller will do that 10%, we probably would not participate in that project. So there is a requirement of some hard cash injection on the front end for any acquisition. And if you're starting a business, we also want to see what have you contributed of your own money, because it's the shared leverage. If we're putting our money in, we need to see that you're putting some of your own in.
And Brian, I was just curious if you had any rules, stipulations, with regard to that and see on a schedule of debts or what have you.
Yeah, no, we have not. I have not dealt with seller notes, and none of the loan memos I've reviewed previously have them on there. But if it was to come across my desk like Tom, I would probably want to see skin in the game as well. But I'm not sure how we would evaluate that from a underwriting standpoint.
Sure, sure. Cross that bridge when we get there.
Yeah, right.
Yeah. Sounds like a normal day at the job.
One thing I would offer is, and I came across this, a small business owner had accepted seller financing on a project,
Mm-hmm.
and it was for a bar restaurant with the real estate, and it was a seller note. They financed the whole thing, and the paperwork was drafted and delivered by the seller's counsel.
Mm-hmm.
Whenever there's something like that, I would encourage all borrowers, get your own counsel. Do not use theirs, because what ended up happening was the paperwork was flimsy and shoddy, and no mortgage had actually taken place. And the property went to sheriff's sale underneath the borrower because she had a sub note but had never enforced her position. And it cost her significant dollars trying to fix the situation. So if never trust but verify. You always want to have someone who's going to be acting in your best interest. So if you have a seller note opportunity, it's worth the investment of having someone who will review it and represent it in your interest, not the seller's interest.
Mm-hmm. Absolutely. Yes, that is definitely a principle of commercial lending, trust but verify. Also, funny little note, when you're asking questions about programs and stuff like that, lending, can I get the loan, things of that nature, um, oftentimes you might hear an answer that begins with, it depends. All right. So just make sure that you know also when you are navigating some of the ins and outs of applying for credit, right? Those sort of things. There's an element of like hypothetical statements to that. If you do this, then dot, dot, dot. Um, it puts things in a more favorable light. Okay. Friends, I think we are just a little bit over time. So, folks who had stayed 5 minutes after one, thank you so much. I would say thank you to the folks that didn't, but they're not here to hear it. So, that is what it is. Um, I would, the thing about like virtual events, I just want to give you guys like a round of applause for taking the time to do this presentation, this lender panel presentation with us. I know you both are busy folks. And I hope that y'all got a lot out of this. The one thing I will say, I think one theme of this presentation is that there is a lot that goes into, making credit decisions. I would encourage you to check out Entrepreneur Works and Pursuit's websites. I checked them out pretty recently, and I will say that they are chock full of information. All right. And of course, we are a great first line. I am Ray Hayden, the capital acquisition specialist at Temple SBDC, and would be happy to talk to you with regard to whatever your capital needs are from a primary perspective, from a first person situation, as it were. Alrighty? Okay. Well, friends, thank you so much again. Have a great rest of your Tuesday.
Thank you all.
All right.
Thank you, guys.
Take care.
Mhm.